Financial Accounting Chapter 3. Introduction. An accounting framework is a set of established guidelines for measuring, recognizing, presenting, and disclosing information in a company's financial statements. Financial statements for a business must be created using a recognized framework, or auditors will not offer a clean audit opinion. General Accepted Accounting Principles, GAAP, and International Financial Reporting Standards are the most widely utilized accounting frameworks, IFRS. In the United States, GAAP is employed, but IFRS is used in most other parts of the world. These two frameworks are intended to be broad in scope and so suitable to a wide range of organizations. Other accounting frameworks are designed for special situations known as Other Comprehensive Bases of Accounting, OCBOA. Underlying concepts. Accounting concepts are the basic rules, assumptions, and conditions that define the parameters and constraints within which accounting operates. In other words, accounting concepts are generally accepted accounting principles, which form the fundamental basis of consistently preparing the universal form of financial statements. The major goal is to establish uniformity and consistency in financial statement preparation and maintenance. It serves as the foundation for accountants' preparation and maintenance of business records. Its goal is to develop a common understanding of the norms or assumptions that all types of companies must follow, allowing for more comprehensive and comparable financial data. The IASB concept. IASB is the International Accounting Standards Board, IASB, and it is an independent, private sector body that develops and approves international financial reporting standards, IFRSs. The IASB operates under the oversight of the IFRS Foundation. IASB issues IFRS and conceptual frameworks. Accounting framework is the basic or concept that accounting reports or financial reports are prepared. Some country has its accounting frameworks for the company or organization operating in those jurisdictions to prepare the financial statements. The framework might be different from country to country and even from entity to entity within the same country. IASB's framework is the conceptual framework for IFRS, International Financial Reporting Standards. The two main assumptions in IASB's conceptual framework used to prepare financial statements: accruals basis and going concern. A hierarchy of concepts and some inconsistencies. The GAAP hierarchy establishes the authority level of various accounting declarations. When looking for relevant guidance on an accounting issue, one should start at the top of the GAAP hierarchy. If no relevant information is found at the top of the hierarchy, the researcher proceeds down the ladder until the relevant pronouncement is discovered. The GAAP hierarchy's levels. The GAAP hierarchy is divided into 4 levels, with the highest levels containing the most authoritative instructions. The levels are as follows, in descending order. FASB Statements of Financial Accounting Standards and Interpretations, FASB Staff Positions, and AICPA Accounting Research Bulletins and Accounting Principles Board Opinions that are not superseded by actions of the FASB. FASB Technical Bulletins and AICPA Industry Audit and Accounting Guides and Statements of Position. AICPA Accounting Standards Executive Committee Practice Bulletins, Consensus Positions of the FASB Emerging Issues Task Force, EITF, and the topics discussed in Appendix D of EITF abstracts. Implementation guides published by the FASB staff, AICPA Accounting Interpretations, AICPA Industry Audit and Accounting Guides and Statements of Position not cleared by the FASB, and widely recognized practices prevalent either generally or in the industry. IFRS and IASB. International Financial Reporting Standards, IFRS, are inconsistent concerning the recognition and measurement of liabilities, both in the conceptual framework for financial reporting and in accounting standards themselves. We show that this is due in part to the International Accounting Standards Board's, IASB, failure to distinguish between the measurement process, which requires a currently observable measurement attribute, and the estimating process, which is fundamentally subjective. While mandating organizations to present measurements and estimates in financial statements, the IASB solely uses measurement logic and language. Our contribution is to identify and analyze this conceptual conflict, to show that it is especially relevant to liabilities accounting, and to draw consequences for accounting research and policy in the areas of recognition, measurement, and conservatism.